What is magic about this space is we all get to own a part of the network. So whatever they do on the space is going to benefit us if we own parts of the network. That's by owning the tokens.
Hello everyone and welcome to the Daily Crypto. We are joined by the CEO of Real Vision, Raoul Pal, who is going to talk about macroeconomic conditions and cryptocurrencies. But before we get started, let's take a look at the Fear and Greed Index for today. As of recording this video, the FNG index is at 20, down slightly from yesterday's 21. Currently Bitcoin and Ethereum are trading for $19,252 and $1,321 respectively. With that out of the way, let's get started with the video.
When somebody tapped me on the shoulder in 2012 and said, hey, listen, you should look at Bitcoin. And I'd seen the rise of Bitcoin, but I dug into it and realized that there were two components here that were really interesting. One was the scarce asset itself could play a role like gold in the financial system. But the blockchain, that's what got me interested, because I thought, well, if this is the proven recorded ownership of everything, then the entire financial industry, that was my understanding at the time, that the entire financial industry could go on blockchain rails. And we solve a lot of problems because you kind of know at the end of the daisy chain of collateral who owns what. So I dug in, wrote the first macro paper 2013 because I wanted to understand, okay, how the hell do you value this thing? And around the time of the Bitcoin white paper, there was a talk about it being digital gold. So I thought, okay, well, let's do the analysis of the above ground supply of gold, the known global reserves, and then back that out versus Bitcoin. And I got Bitcoin in 2013 when I wrote the piece was $200. And my analysis said, on a fair value basis versus gold, it would be worth $1 million. And that was with gold at the time around 1,300. So not a million miles from where we are today. So I was like, okay, wow, this is the best risk reward I've ever seen in my entire career. But I have to assume I'm a complete idiot. So I discount myself by 90% and say, okay, your analysis says 1 million. Let's assume all your maths are wrong. You're totally stupid. Let's call it 100 grand. At 100 grand with a $200 price, it was still the best risk reward I'd ever seen in my entire life.
When Raoul first discovered about Bitcoin back in 2012, he wrote a paper in which he compared Bitcoin to the physical gold and immediately realized how big of an opportunity this was. Back then Bitcoin was trading for just $200, which is why Raoul says that is the most incredible risk to reward ratio he has ever seen during his investment career.
So I bought it and I held it. And it went up 5x in 6 weeks. And obviously I'm now thinking I'm George Soros. I'm probably the best investor the world has ever seen, maybe. And then it falls 85%. But my hypothesis, look, I'm a long-term macro guy, so I didn't really care about that. I treated it like an option. I figured it could go to zero. You know, this is very early days. You know, we had to get through Mount Gox and all of the stuff that we've been through within this space. So I was like, I don't care if it goes to zero. I sized it accordingly. And it fell 85%, but I was still interested in it and continued to watch it. And then before you know it, 2017 comes along and it's now up 10x from where I bought it. And this was the time of the forking wars. This is when they're trying to fork Bitcoin to different chains. And I'm like, I don't really understand what even this means. We now have a better understanding of how this all works, but we didn't then. And I'm like, I'm going to get out. I've made 10 times my money. It's been a fantastic bet. I'm out. It then went up another 10x. So I got out at 2,000. It goes up to 20,000, right? Which was mind blowing. Yeah. But again, I was like, it's fine. But I had a hypothesis that this was not dead. You know, it was going to go through a cycle. It had gone through a hype cycle. It needs to calm down. Again, we fall like 85%. And my hypothesis was that macro and crypto were going to meet because I came into this space saying we need this asset.
Even after Bitcoin dropped by more than 85%, Raoul still believed in the fundamentals and held on to his position, which paid off in the 2017 bull rally. Although he got out early at just $2,000 per Bitcoin, it was still a 10x return on investment in a very short period of time.
The macro is bloody awful. It's the largest, most concentrated tightening of rates that I think we've seen almost in history. We have the largest tightening of financial conditions on a broad measure. as opposed to, a lot of people use the Goldman measure. That's not that broad because it uses equity markets, and it's a weird kind of feedback loop between equities and that. But if what I did was use the rate of change of rates, the rate of change of the dollar, and the rate of change of commodity prices, and it gives you a understanding of how tight money is. The other way you can look at it is the number of central banks as a percentage of total central banks raising rates. Those kind of things give us a growth shock that is ahead, that we're starting to see, that is quite sharp and severe. So we're talking about something where, GDP growth falls 3% or so. So a really decent sized recession. But it looks like my forward-looking indicators suggest that the bottom of this growth shock comes actually pretty soon, like March 2023.
According to Raoul Pal, the macroeconomy is in shambles after the third consecutive rate hike by the Fed. However, some indicators used by Raoul suggest that the bottom is actually pretty close and we might set it sometime in 2023.
The macro is bad now and is going to get worse. The narrative you will see is, well, the macro is about to get terrible, all assets must fall. But once you start doing things like doing the year-on-year rate of change of the S&P or the NASDAQ, they're actually pricing in an ISM, the Institute of Supply Managers survey, of about 40. So that's pretty severe recession as it is. Could they price in a bit further? Could it be at one lower stab? Sure. But these are forward-looking assets. And what they look for is the turn. Why the turn? Because that's somewhere in the next 6 months, the central banks will most likely go, okay, unemployment's coming up, inflation's coming down. We have to look after, our mandates are unemployment and inflation. Inflation's going to be maybe stickier or higher. I don't believe it will be. I think it actually goes negative. But unemployment's going to be coming up. We need to at least stop.
One of the most used indicators by Raoul Pal is the ISM indicator, which is ready to touch the 40 mark, indicating that a reversal is in the cards and we might go up again very soon. This is also backed by the fact that at some point, the Fed will realize that inflation is getting lower while unemployment is increasing, and the least they can do is to stop increasing rates and let the economy catch a breath.
What is magic about this space is we all get to own a part of the network. So whatever they do on the space is going to benefit us if we own parts of the network. That's by owning the tokens. So I don't really care. As long as I've got my stake of the network, however the network is built out and whoever builds on top of it. So what they're saying is, we like the network, we like the technology, we want to build on top of the technology, and we want to build the ability to custody and transfer assets. Right? That was my hypothesis from day one, that was going to happen. It's just taken time. And I've spoken to the London Stock Exchange, I've spoken to everybody. They're all going to do it eventually. I've spoken to Dubai Stock Exchange. They're all going to do it. We've seen the European Investment Bank, the EIB, issue bonds on Ethereum. They're all testing it. So my hypothesis has been most traditional assets are about $200 to $300 trillion in market cap, whether that's real estate, bonds, equities. And my guess is this will be the same because it's going to capture a share of a bunch of that. So, 13 trillion, yeah, add that onto into the mix that gets us to $200 trillion of market cap. It's coming without question. The best thing is own the bloody token.
Cryptocurrencies are a new asset class altogether and will take some time to mature as a financial market, as the total crypto market cap is just $1 trillion. This pales in comparison to other assets that have market caps in the hundreds of trillions. Imagine the price rally in Bitcoin as even tens of trillions flowed into the space.
Well, if they're going to give these wallets out to 300 million Europeans and 300 million Americans and 1.3 billion Indians, what is the probability that digital assets, that $400 billion worth of value, remains at 400 billion? About zero, right? This is how good the bet is, right? It's almost impossible to architect an outcome where over a period of time, prices are not massively higher.
Yeah,
and I know that sounds ludicrous and it sounds hopium, and there is almost no way. We've got too far in network adoption. When the central banks all said, yeah, we're going to join the party, that to me was the signal, is right, the game is won. Regulation is the noise. It's a few speed bumps en route, but it's one.
Raoul is talking about central bank digital currencies here and says that even though it's an attempt to control the crypto markets by the governments, it will actually encourage people to invest more as it will increase network awareness. Whether CBDCs are good or bad, that's an entirely different debate, but there is no denying that when people accept them, it will only attract more people to cryptocurrencies.
It always amazes me, the whole argument around, well, they're CBDCs, they're going to control you. I'm like they don't have access to your bank account now? Like they can't impose a cost of money, cheapness or expensiveness of borrowing, lending money now? Like they can't tax you? It's like they do this anyway. And if you think it's all about privacy, tell me how much actual transactions you do in notes, physical notes. Virtually none, right? None of us do anymore. So we use our credit cards. They've got all of that data. And then we're on Google or Amazon. They've got all of that. We gave up our privacy years ago. It's people are just making a deal of something that does not exist. And that essence comes from the people who want to hold gold bars and move them around the world. Well, good luck if you want to buy a t-shirt online with a gold bar. It ain't gonna happen. So look, governments will be governments. Our job is to live in a democracy, to vote them in or out if they overstep their mark. Now, governments have been more controlling over time, and part of that is to do with the societal problems that the debt and demographics have created, and I don't think that's going away. Now, central bank digital currencies allow them to track the money around the system easier. I get that. But they're going to do that anyway. I mean, blockchain, every transaction is available to them.
Raoul argues that people are just making a big deal out of CBDCs because the governments have always tried to take control in all aspects of our lives. Those who are against the use of CBDCs argue that it is an attempt by the government to gain control over everyone's financial records. But this argument is very weak because they can do the same with someone's bank account or credit card.
So if you zoom out, the chart of Bitcoin or ETH looks nothing like the NASDAQ. When you zoom in on the sell-offs and periods, it looks like they are. And those are the macro cycles that dictate all assets. Why? Because we've had quantitative easing. Quantitative easing increases the number of currency, fiat currency in supply, and lowers the value of the denominator. It rises all asset prices. But those that have higher adoption effects rise further, which is why crypto rises further than most technology stocks, which is why they rise further than oil stocks, because it's where you are on the adoption curve in this particular world. So when you zoom out, they're not correlated. When you zoom in to here and now, they're correlated. And that's okay. I mean, what isn't correlated to the dollar? What isn't correlated to interest rates? What isn't? That's how money works. But zoom out, it's all noise. It depends on your time horizon. My time horizon is not in the 18-month time frame. My time horizon lies outside of the 18-month time frame, in which case I don't really care, is the point.
If we look at the Bitcoin chart, it can clearly be seen that we are at the starting and adoption curve. The fact that the crypto market is correlated to the stock market is simply the result of an early, immature market. Raoul believes in the long term and sees Bitcoin become a separate asset class of its own that will break correlation with the stock market in the future. Thank you for watching this video. Please drop a like and subscribe to our channel because we upload content like this on a daily basis. See you guys in the next video.